Hello viewers, welcome to Sensor 360 Investor channel where we use best practices from around the world from the companies that we invest in, apply those to the investing process. Okay, so today I'm going to do a short video on the topic of equities, and we're going to focus in on a topic that will be quite relevant over the next bull cycle, and that is the era of the stock picker returns. So throughout the super cycle starting around 2013 and from about 2010 onwards, where we've had an environment with QE, it really has been a passive investors market. And as that changes with the ending of QE and now into QT, then the game's going to change as well. So what worked over the last decade may not be the best strategy going forward. So we're going to take a look at that. Okay, so before we begin, just a quick word about the disclaimer. Please pause, read, and then continue. Effectively, channels not providing financial advice. And please take a look through this. Okay, so without much further ado, let's begin the show. So I'm going to start by taking a look at the four major indexes. This is just an annual chart of the four, and we can see just the basic shape is lower left, upper right. So from 2000, basically, the market's gone up significantly, and the Dow Jones not as dramatic, but still nice pattern to the upside, as is the Nasdaq Composite, and as is the S&P. The S&P kind of had a sluggish period until the super cycle decided to hit here, and then the market took off. Okay, so we know that over the past decade, the tendency and the bias of the markets has been in an upward trajectory. So a passive investor could just buy the S&P 500 and sit in it, and they would have done extremely well. And when earlier, it didn't work. So we can see markets change, right? So through this period, you would have just had made no progress as an index investor. But through this period, you definitely would have done very well. All right, so let's have a look at those indices, markets all on the same page. And here we have that top gray line is the broader Nasdaq, the composite. This light blue one is the QQQ, and then this green one is the Russell 2000. The purple is the S&P, and the white is the Dow Jones. And we can see that from 2000, the broad Nasdaq has been overall the place to be, closely followed behind by the QQQ, and then the small caps. And the place not to have been would have been the Dow and the S&P. However, if we take a closer look at this, we can see that for the most part, up until about 2013, 2014, the small caps were also doing really well. And previously, in prior periods of investing, small caps have been the one that have outperformed quite handsomely. But the shift happened there, especially as QE started to kick in, and we've seen this massive rise in the Nasdaq, driven by the big tech stocks. So, but let's also take a look at. So we had a sea change around here when the super cycle began, and from there we can see how really the tech stock has driven the market, and that's why FANG has worked particularly well. And so somebody could have just hidden in, got into the large technology stocks, the mega caps, and they can throw Microsoft in there, Tesla in there, Adobe in there, a few others, and you would have done exceptionally well in those. And even if you just bought the Qs, QQQ, you would have done really well, exceptionally well as well. So passive investing, you could just sit there in an ETF and you would have made off like a bandit. If we look at the period over here, which is blown up here, you can see that it was a different story. And in this story. Small caps and the tech stocks, and Nasdaq led the way, and they were both kind of joint leaders. And there were periods where the small caps did outperform the Nasdaq, but so really you could say that splitting your assets between small caps and the broader Nasdaq would have paid dividends for you. Okay, so let's take a look at a couple of the indices. So this is the Nasdaq, and we're looking at 2022. In 2022, the index fell from its peak down to by 33%, and so this is using the closing date of 21, so the end of December to the end of December the following year. So it's about 1 day difference between the performance of the ETF, which looks at the opening of January. So a slight discrepancy, but it's the date, the 1 day date. That's the delta. But if we looked at performance over the year, we can see that 907 stocks out of 1,371 beat the index. So you had that much opportunity to have outperform the index. So as a passive investor, you would have taken a bath of 33%. But if you're an active investor, you picked any stock that sat above 907th position in the list, you would have been in the index. And had you picked out any of these stocks, and this is the top 25 performing stocks for the year, had you had any of these, you would have done exceptionally well. And there's a few names that pop up here, which we've seen that pop through on various lists. First Solar, SWIR, and notably the SQQ was up 30%. Now, what's interesting is that even though the broad index was down 33%, the SQQ, which is the triple inverse, was only up 30%. So you didn't get a 90% return by playing the inverses. So that's a function of how these inverses settle on a daily basis, and a few other mechanics of how inverse indexes work and calculated. Okay, so let's look at the S&P. So the S&P was down on the index. It's 19.44. And if we looked at the table, we can see out of 502 stocks, 296 beat the index. And then if we looked at the top 25, energy was the big runner last year. So you had plenty of opportunity because the sector tipped you off as to where to fish. You had plenty of opportunity to pick some of these off, and some notable names like Oxy, Schlumberger, First Solar. So here again, Steel Dynamics was on many momentum lists. EOG, Enphase was on a lot of momentum lists, and Solar had a good run last year. So you had lots of opportunities. Had you picked any of these, you would have handsomely beaten the S&P 500 as well. So the indexes can be beaten by retail investors for sure. Okay, so key takeaways are active management outperformed passive index investing last year, and the art of stock picking, which over the last decade gave way to buy the dip, has meant there's a lot of investors that came to the stock market that don't have the discipline or the methods in place, because buying an ETF worked, and why not? And then so go on a forward basis, investors really need to either educate or re-educate themselves back into classic investing. And we see, as we see, retail investors can beat indexes through good stock picking, and that was demonstrated last year. So what do you need in terms of to help you? So certainly a few things like you need quality research, and be able to sign up to some services and tools that you'll need. You need a disciplined process. So because it does take time and investment of time to study and identify which stocks to invest in. That means you have to have some amount of financial savvy to understand the financial books, the P&L statements, the balance sheet, the cash statement, and you need a certain amount of business acumen um, to understand the business and its competitive edge and the industry it works in. And last but not least, you also need to have a paradigm shift in your mental um, process to shift away from passive investment, where you just say buy an index or a mutual fund um, or an ETF, and then just sit on it. To actively managing your positions, knowing when to buy, knowing when to add, knowing when to trim, knowing when to sell. And that is one of the reasons why in the Sensor chapter, we have a chapter called SGSG, which stands for Stable Growth Stock Group. And that focuses on this discipline. So that's it for this video. I hope you found it enjoyable and somewhat informative. I will close out. Thanks for watching. Thanks for listening. I will see you on the next video. Goodbye.